Okay, so welcome to Capital Discussions. This is the Kevlar 2 December 2015 trade review. I think we're going to get to the January trade as well. Before we get started, a quick disclaimer, the Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And as you can see on the yellow, this is for educational purposes only. So with that, Jim, it's nice to get back into my PowerPoint mode and put this together. I think it turned out okay.
I think so. Thank you so much, Tom. I really appreciate it. Okay, guys. What we're going to be doing is that, as Tom said, we're going to be going through the December trade. I'll walk you through. If you have any questions, end up asking. December was a rough month, right? There were a lot of adjustments. We started to trend, and as soon as I'd make an adjustment, we'd end up going the other way. I had to stay in the trade a little bit longer than I liked. Unlike the January trade, which there was just one big adjustment that I had to end up making, repositioning. Left it on for another, several days and was able to get out. This was the initial structure that I put on. What you can see here is that my initial structure, my calls were 75 points wide, and my puts were 100 points wide. I do that often, okay? And it depends totally on how expensive the puts are. When the puts below the money are much more expensive, then I won't do a broken wing. When they're not that much more expensive, I prefer to start with a ratio. A lot of people end up asking me a ratio. If you had seen me present this at the SIBO, it must have been about 8 years ago, I used to use a 5 to 7 ratio. I still use something like that, $75 to $100, $50 to $70, $50 to $75. I'll end up using that. What I'm basically looking is what's going to end up giving me my best T plus 0 line. Quick comment on the T plus 0 lines. For those that you use option view, it's a little bit more accurate. What I've noticed on this, and this is true of most butterflies when you end up having a broken wing or when you even use a regular butterfly, is that sometimes your P&L, right below the curve is somewhat overstated. So it may end up being a little bit lower than it might be expected here. Basically what I'm trying to end up doing is drawing that line as straight as possible. Tom and I were joking when I put the February one on. It was so flat, I was joking that I'd need a ruler to actually make it, flatter or straighter. So that's basically the goal. Now, when you do that, unfortunately, you're not going to end up having as much theta, but it's a trade-off, right? It's a more manageable trade. It's easier to end up dealing with, and you have more protection on the downside. When I ended up putting this on, didn't need to do anything for 10 days. You can end up taking a look at the P&L. It never really moves very much. One of the things that you can end up also seeing here is, and when Tom and I reviewed this, he thought that this would be a really good idea, and thank you, Tom. It was a great suggestion. He asked me where I end up looking. Okay, when I have a broken wing, I'm always looking at my upper long strike. And so I'm always putting it on when I'm below the strike. So this is how many points up to, or how many points below that upper strike we are. So when I have 18, or 19 points to the upper strike is where I end up putting. You can end up seeing that, we ended up moving higher. Yeah, of course, you can end up taking a look at the price of the SPX over here, and you can see how things ended up changing. But this is where my eye always goes to. Where am I on the upper strike? When I have a broken wing. Once I got to 50 points above, and you can end up seeing here, you can do the math if you want also here. Here it's just a little bit easier. You can see I was very close to the upper strike. I blew by it by 50 points. My deltas got to end up being rather significant. This was a really good chart also. When Tom ended up saying to me, he said, hey, what happened, over here? If you take a look at it, how did you move almost $1,000 in P&L when we only moved 0.1 on the SPX? One of the things you need to end up knowing is that when your P&L is, it's not right. Okay, do you have any issues? Did you get bad pricing? the thing over here that jumps out at you is that I was not 74 deltas positive. It happened to be the price, okay, the way things went. Now remember, I have 5 different strikes here. If one of them is wrong in one direction, because they kind of all cancel one another out, at least that's the objective, it can end up making a huge difference, okay, in the deltas or in any of the Greeks. You can also see that what ended up happening is not only did the deltas get so big, but my gamma actually went to negative. So I knew that was a bad price, so I ended up skipping that. And the key is to end up, not getting caught up as much on what your P&L is as versus what's my graph look like and where am I in relationship to the overall trade and my expiration graph. You can end up seeing that the adjustment that we ended up doing is that here was the initial position in blue. Here's the trade that we ended up doing, and then here's the new position. The way I had done this is because I was going to end up rolling the entire butterfly up. I could have taken the whole thing off, and I could have repositioned it. I chose not to do it that way. What I prefer is to move it a leg at a time. So what I ended up doing is that I rolled my calls up. I rolled my puts up. And by doing that, because my delta has gotten positive, significantly, when I consider where I am in the trade and the piece of the Vegas actually got to be positive also. It's not something that's a hard and fast rule with me, but I don't like positive Vega trades. Let me go back. When I'm sitting here in the valley of death, so to speak. I don't worry, and the blue trade is what was before. The red trade over here is what was after. So you can see on the blue graph, I was pretty significantly above my long strike. And at this point, I'm kind of in no man's land. I don't mind being out here for a couple of days, but once I end up getting, significantly above, I know I have to come back. I know my Greeks are not going to end up helping me very much. So the whole concept was just to end up taking the trade, moving it up. Now, the problem is if I moved it up, I still ended up having a bit of an issue if we continued to grind up. So I made the decision at this point to add another call. Okay, and you can see that over here, that I had one and then I ended up adding another one. Now my red line, remember this is the new graph, I feel pretty good if we run up. I'm okay. I got plenty of room to the downside. I got, probably 100 points or so to the downside before I'm really worried about things. And then what happened was that we just grinded. If you take a look, nothing really ended up happening. We moved a little bit up. This is one of those areas, all my Greeks look good, but they're just not giving me, my money. Okay, it's taking a while. And so what ends up happening every single day on here is that my deltas are going to change. Let me show you on the next graph. You know what? I have to end up showing you on these two graphs. So what ended up happening here is that my red line, which is the trade before, it's going to continue to end up moving up at a much higher pace on this side. And if it moves higher on the left-hand side and lower on the right-hand side, what happens is the slope of the red line, or my delta, right, because that's what delta is slope, it's going to become more and more negative, right? Every day it's going to be going a little bit higher from upper left to lower right. And so just because the time is passing and I'm out here, closer to the edge, I thought, well, how do I end up, one, getting my deltas in a little bit of better shape? Two, how do I take a little bit of risk off the table? So what I did, and I'm going to explain it here, and then we're going to go back and look at the actual chart. I took my calls and I rolled my short calls and I rolled them up. Okay, you can see 25 points. And I took my long puts that I had, and I rolled them up 25 points also. Let me go back and show you. Right here. The way I ended up doing that, was with buying an iron condor. You can see here that I bought the 2025 and I sold the 2050s. There's the vertical, okay, and you can end up seeing the new position. So what I did here was I took some risk off the table, right? Where I had a 100-point, okay, wing beforehand, now I have a 75-point wing. And I did the same thing on the downside. So basically I took a butterfly, and you'll see it from here. I took a 100-point wide butterfly, and I moved it into a split strike, 25 points apart, split strike, 75-point wide butterfly or iron condor. This ended up helping a lot to be able to end up adjusting my deltas, and I know that the way my Greeks are going to trend every day. I didn't need to do very much for the next almost 2 weeks. You can end up seeing that my distance to my upper long, okay, is that I'm continuing to slip away. I'm getting further and further down towards the bottom. And at this point, remember, I'm 75 points, okay, on my call wing. So if I'm 75 points below my upper strike is where my center of my butterfly from the call perspective, right? Because the put's 25 points below that, but the call is about there. So you can see that I'm getting pretty close. My deltas again are getting a little bit more negative. Now the challenge is that I'm getting a little bit flatter at this point. Okay, so let me show you what ended up happening. Is that I just said, while we're here, we looked at a support level, and so, I thought I was a little bit smarter than the market. So what I wanted to end up doing is I wanted to just get my deltas a little bit flatter, and so what I did was that I rolled my long calls deeper into the money. Okay, when you roll your calls deeper into the money, what I did was that I increased my delta. You can see that here, times 2, and I ended up helping my theta a little bit. I thought we're going to end up finding support here, so therefore let me roll them deeper in the money. This way, when it bounces back up like it did the first time, I'm going to have greater deltas. I'm going to have more theta. Everything will end up looking better for me this way. So that's what I ended up doing, and I missed picking the, right, when I rolled higher, I missed picking the worst time of the day by about 15 minutes. It doesn't do a lot to the expiration graph, but you can see it helps my Greeks somewhat more to the upside. Doesn't really end up giving me any big risk until we start to end up moving down 75, 100 points, and then I need to start to end up worrying about it. And of course, after I did it, what happened is that we moved down. You can end up seeing here, let me go back to this chart. You can see that I made this price adjustment when we were at 2066. A couple of days later, we moved so far down, okay, that I'm, now remember where my center strike is over here. Okay, my short calls are 2050. I'm below my short calls. My short puts are at 2025, so I'm in between. Remember I told you there was a 25-point split strike butterfly or 25 points on the iron condor? So what ends up happening here is that I'm in between. So now I start to worry, what happens if we move down and move down significantly? So what I did was that I used a condor to roll down my puts. You can see that my existing position, I was short the 2025 and I was long the 1950, so it's 75 points. I rolled down my short puts. I rolled them down 35 points. So I'm buying a 35 put spread, a put vertical. I'm buying a 35-point put vertical, and I rolled down these puts. My long puts, I rolled them down only 25. So if you see what I've done here by buying a 35 put wing and selling a 25-point put wing, that's going to end up giving me a lot of extra negative delta. And at this point, I wanted to, 1, take some risk off of the table if it moved down, 2, get positioned, because once we ended up breaking support, what I thought was going to hold, I went from being bullish to bearish, and I shouldn't end up have had any opinion in the beginning, but because I did get a little bit more bearish, I wanted to get my position back to what I would consider to be more neutral. Carrying this much negative delta compared to this much theta is something that's very reasonable, okay, the way I end up trading it. So you can see what I did was basically I just expanded out to the left, right? I expanded my short put, went further, went 35 points down, and you can see my short call went 25 points down. Normally when you roll down, you put more risk on the table. The reason why the after adjustment is less is because of what I had mentioned before, the 35-point long wing versus the 25-point short wing of the put condor that we used to end up adjusting. Okay? So now I'm flat. Now, here's something I'll end up mentioning. I'm not crazy about having such long strikes between the two, between my short put and my short call, this early in the trade. The wider I make them when I'm this far away, the more I know I'm going to have to stay in the trade. But I felt I needed to do that in order to end up adjusting and managing my risk. You can see my red line here. Okay, went down pretty significantly. Now my after trade adjustment, my after adjustment T+0 line, you can see that I'm much better protected to the downside. And if we move up, I know that volatility is going to come out of the trade, so therefore I know that this line isn't nearly as bad as it seems. I know I'm actually going to be making money, okay, with this little difference because the implied volatility is going to come out. That was a point that I wanted to end up making. My eyes, because I've traded and I know that there's a difference between how much things are going to be accurate compared to live between option view and thinkorswim, and I've used thinkorswim for so long that my eyes have just adjusted to this. I was joking with somebody once that it was kind of like my very first motorcycle. Like anybody who's driven a motorcycle, I laid my Kawasaki 440 on its side, and when it went down, the handlebars got a little bit bent. So whenever anybody else ended up riding my bike, they thought that they always were turning a little bit to the left if they tried to straighten because the bars were bent. I knew my bars were bent. I knew they were inaccurate. So I knew how to end up driving, and I knew where the line was. The exact same thing is here. So I know that this blue dotted line here is actually understating my performance. So I'm not worried at all because after this type of a pullback, and here's what you can end up telling from the graph, after this type of a pullback that we've ended up having, we know that volatility is going to be a little bit higher. It's going to be a little bit more sensitive, and we know that if we do end up finding support and bouncing back up after we ended up breaking it, that the volatility is going to come out and the negative volatility is going to help this part of the curve. People have asked me a lot of times, how do you know what part of the curve it's going to help versus which part of the curve it's going to hurt when you're looking at your T+0 line? The answer is that there's a whole bunch of things that it's dependent on, but in general, what you'll find is that when volatility gets crushed, when it goes down significantly, your T+0 line will move closer to your expiration graph. When volatility pops and it expands dramatically, your T+0 line will move away from your expiration graph. There's almost this relationship between volatility and time, and so that's the way I've always looked at it, and it's a very helpful way to end up looking at it when you're looking to adjust your trades. So what we ended up doing is you can end up seeing that my distance from my long strike was pretty significant. You can see that my P&L, okay, I'm still stuck where we are. And now it comes time to end up, well, let me tell you what happened here. So the market ends up jumping back up 12 points. So we were above the support level that I feared. So I gave it a day to saying, well, was it going to end up going back significantly? It didn't. So therefore, the adjustment that I put on 2 days later, I took off and I lost money on it. Okay. But as you can see here, once we moved significantly higher, okay, and you can end up seeing that my P&L, I really did not lose as much as they said I was going to lose because we jumped up because the vol came out. The problem is that I'm losing some of my Vega, and if we continue to move up, I don't like the way my T+0 line looks if we go up. The challenge that we have is that the closer you get to expiration, the more sensitive, the more gamma risk you have, right? The more sensitive your T+0 line tends to be with time, with volatility, with price movement. And you can end up seeing here that there was 30 days left to go to expiration when I ended up making that adjustment. I'm at the point where normally I'd like to be out of this trade by now, but they're forcing me to stay in it. Okay, so 3 more days go by. You can end up seeing not a lot of movement, right? I mean, we're just kind of spinning our wheels here. But look at what's happening to my delta. And I wanted to stop here. When we're out on the right side of the graph over here, to the right of our center strikes, what happens is that every single day, the T+0 line gets a little bit closer to expiration. So every single day, the slope of my T+0 line is going to go from upper left to lower right, and it's going to get steeper and steeper and steeper every single day. So people end up saying, well, can I just adjust with when I get to a certain number of points within my long strike? And the answer is no, you can't end up making up rules like that, because it has to end up doing with your days to expiration, has to end up doing with your put skew, it has to end up doing with your entire volatility levels of the entire curve. And, right, there's 2 things, how high volatility is in general, and then how high the puts are below the money versus what they are, let's say, at the money, and that's skew. So I know that every single day this is going to end up getting more and more negative, even though we haven't moved at all. So 4 days go by. My P&L is recovered a little bit. I'm back in the black, but it's time to making an adjustment. What do we end up adjusting? We end up basically taking the calls. You can see that I had my calls before the trade. I had them at 20.50. Well, I rolled them up. Right? So I bought this this call vertical. And I did pretty much the same thing on the put side. Okay, you can see that my long puts were at 20.50, and I rolled them up. So basically I rolled both sides up. And you can see that here. I took these puts right here, right? See them in the blue? And I took them and I rolled them up 25 points. And I took these the calls, and I ended up rolling. Basically everything got rolled. Okay, and you can end up seeing that, and it ends up helping my T+0 line. Okay, on this graph, Tom, I'm pretty sure the before and the afters are switched, right? Because I know I rolled everything up. And we can end up seeing that from here, right? Because my deltas were more negative. Now they're flatter. So we're sorry about that. Maybe before we send it out, we can end up getting that one corrected.
Yeah, I'll fix it.
Okay. Okay, thanks. Okay, now I'm relatively flat. I'm looking pretty good. Now remember, my T+0 line is still going to get more negative every day, but it's not going to happen at the same rate. You can end up seeing, okay, that the red line, the after line, which is the red, is a lot flatter, and it won't end up adjusting as rapidly. And at this point, you can end up seeing that my P&L just starts to end up, okay, we start to end up making, a little bit of money. Now you can see that we ended up having, one nasty pullback day, okay, and then it bounced right back. And here's what ended up happening. My P&L did give back money, but I went down to 2043 is where we closed. At 2043, you can see right here, I'm still, okay, I'm still, in a very good position that we pulled back. Now, I should be making more money, but because volatility has popped, just the way I knew I wasn't going to lose as much money, okay, going to the right, going back to my bent Kawasaki handlebars, knowing where the line's really going to be. Well, I knew that I wasn't going to really be making money here if we came down, but I knew that it was only a temporary thing in the sense that I'm losing it to volatility. And I don't worry a lot about losing points to volatility as we're coming down until we get past my short strike. Then it becomes serious, right? Then you can't mess around. But if it's pulling back, there's really, especially with this market, there was nothing to end up doing at this point. And so when it bounces back up and volatility comes out, you can see we're down. These are pretty significant moves, right? We had 15, 16-point moves, which is, reasonable. Then two close to 40-point moves, both up and down. At this point, my P&L is looking pretty good, right? And so they forced me to stay in the trade a little bit longer. Okay, and so at this point, it's time to take our money and run. We closed out with $3,700, almost $3,800 on a planned $50,000. For those of you that were trading along in the trades, you know I had done it 1/10 the size. I had sent everything out. So we looked pretty good at this point. And so, there's 14 days left to expiration. This is the last day that, I'd like to stay in the trade. I won't say that I never close after this, but at least that's my rule. I try never to. I don't even like to close here. I'd rather be out with 4 weeks left to go. But because they wouldn't give me my money and they've made me play longer, I had to stay in. Okay. Any questions about that trade? And that was the final position. Okay. Let me take you through January's trade because it's actually much, much quicker. Okay. In January's trade, I started it. Okay, I started it with all puts. I do that sometimes because I know that I'm going to end up adjusting. I tend to end up using irons all the time. But when I ended up pricing both ways, because I wanted to have the put wing a little bit longer, not dramatically longer, a little bit longer, the pricing just worked out better on the whole thing. You can see here that my upper wing, and I'll call them upper and lower wings, right? My upper wing is 50 points, and my lower wing is 65 points. Okay, so there's the 5 to 6.5 ratio. Remember, I told you I like to end up using 5 to 7. The challenge was that when I used 5 to 7, 50 points versus 70 points, I didn't get the deltas that I wanted. Okay, I wanted to end up getting my deltas at a certain level. I wanted to get my gammas to be relatively flat. So this is what the graph looks like. You will notice that when I don't use buying long calls, that was the other thing that was different here. I did not buy calls here. And the reason why I had done this was that volatility had been all over the place, right? I mean, we'd been bouncing up, we'd been bouncing down. One of the things that you may have seen that I had done some work with a few other people at Sheridan Mentoring when I was trading with those guys, is that Dave Wilson ended up, was it Wilson? I forgot Dave's last name, ended up doing a bunch of coding for us because what I've always noticed is that when my daily ranges, Robinson, thank you very much. Okay, bear trader, right? Great mathematician, by the way. If you guys know Dave, Dave used to end up being I think a fellow, a very high level engineer at Intel. He's written a whole bunch of mathematical stuff. He's published papers, and so he was a really a great guy to end up working with. What we found and we knew as traders, okay, was that when the daily ranges get bigger, what ends up happening is that the risk becomes higher. Okay, many times if you take a look, and by the way, the graph is called average true range, and all an average true range is it's the high versus the high versus the low of the day, including any gaps that might happen from the day before. And when that average true range starts to tend to get bigger, you're going to have some challenges, meaning that the market's going to be a lot more whippy. It's going to end up being a lot more volatile. You're going to have to end up adjusting your positions more. So what we ended up doing, Dave and I did, is that we compared a whole bunch of things in terms of how much the short term, a couple of days, ATR had moved versus something longer, and you need to compare at least an order of magnitude difference. So we would look at, let's say, 3 versus 30, and we ended up calling the study the Danger Will Robinson graph because it ended up showing us when we ended up having danger. So what I'll tell you right now is that my danger, Will Robinson, is my ATRs are a little bit bigger here. I want this to be flatter. I want to have a little bit more room on the upside. If it runs up, I don't want to be forced to end up adjusting if we run up 50 or 60 points, only to have it come back down. So because my T+0 line is relatively flat going above and can only go so far down, right? It can never get below the expiration graph. And my expiration graph is so well managed to the upside, I know that if we're up there, I'm going to make a little bit of money. I might not make a lot, but I'll be able to get out of the trade at a small profit. If worst case, maybe flat or maybe even a small loss in worst case scenario. So I'm not going to end up doing anything. So I like to end up putting this out here. I know that Dan Harvey ended up showing this as his road trade. Dan and I used to talk. We would end up laughing because we would do work and then we would end up comparing our notes. And I can't tell you how many times we've done that. And our work was like, 80, 90% the same. So this is where I'm going to end up starting. I have my Greeks where I really, really like. I can sit in this position whether we move down or whether we move up. This is a nice trade because, remember, I put this trade on and I hadn't gotten out of the other one yet. The other one I had reduced. Remember, I kept reducing the amount of money that I had in the trade, but I'm not out of it yet, and that one's taking my attention. So I want this one to be nice and easy to manage. And basically, that's what ends up happening. You can end up seeing here that the market does run up. It runs up about 50 points, okay, from when we put it on. Okay, exactly the opposite of what I feared. But I also was feared that I didn't want to get caught if we ran up. And you can see that this was just first day pricing, but it's making a little bit of money. Okay, not a lot, but it's making a little bit of money. I am above my long strike, and I've been out there now for whatever it's been, about 6 days. I don't count that. Some people say, oh, well, if you're out in that valley of death, and it's so many days, then you need to end up adjusting. Now, remember, I don't have a valley of death here. I kind of have a plateau of unpleasantry. Right? There's nothing really dangerous if I'm out here. So I'll give it a few days and have it come back. And, if it wants to keep wandering, further and further to the right, then at some point I'm going to have to end up doing an adjustment. Well, that's what ended up happening, right? It kept going further and further to the right. We got through Thanksgiving, and at that point I had sent out a note that I was going to end up doing an adjustment on the Friday after Thanksgiving. And basically, here's what I end up doing. Remember I told you I don't mind putting on puts in the initial part because with 49 days left to go, I'm going to get it back into my iron. So basically my initial position was, remember we had the 50 points on the upside, the 65 points on the downside. So basically what I'm going to end up doing is that I'm going to end up rolling the entire position up. So I'm going to end up moving my short puts or my lower wing. They're still going to end up being at this point I moved them to 70 points. So I moved them from 50 points or 65 points to 70 points. And you can see what I did with the calls. The calls are also 70 points. So now I have a symmetrical butterfly or a symmetrical iron butterfly. At that point, I need to end up putting on my longs. Okay, very important that I end up putting on my longs. So when you see what ended up happening is that it was a lot of work. Okay, it was a lot of work to move that, and the graphs, all I did was kind of shift it to the right, and I took care of my T+0 line if we run up here, because if we're going to go back up into this upper trending, grind them up higher market, I want to end up being, well protected to the upside. And because I have a pretty flat, right, if you take a look, my gammas are actually positive. I actually have positive gamma. Okay, so I take a look at it, and I'm pretty good. And at that point, there really wasn't much. Okay, you can see that we did move down 40 points. We bounced. Look, I mean, these were some pretty ugly days, right? Down 40 points, up 46 points, and so you can see that. And then we started to drift back down. Okay, and so thank you very much. Again, Tom, we need to end up changing the labels. I rolled everything up, and I was talking to it, but the labels were wrong. So the green line is the before, the purple line is the one after, and I rolled everything higher. Okay, so Tom, if we can end up changing that one also, please take a note. Thank you very much, Bear Trader. And so at this point, two things ended up happening. Okay, my my changes are becoming, pretty high. Now we're starting to grind down again, and it's a little bit bigger than a grind, right? We're down 30 points in 2 days, and you can see that there was, and I'm looking at my profit. Now, there are, how many days were there, Tom? I guess 49 then after this. There were more than 30 days left then of going after the trade. But the point was I took a look at 38 days, okay. I took a look at where I was, and I was also looking at my February trade because I start to end up looking at trades at 80 days. I start to look at them. I usually never put them on before about 75 days. So I was looking at the February trade, and remember, I only like to have one trade on at a time where possible. And so I looked at the profit. I was up, my 10%. And so it was time to take my money off and put on the February trade. Let me make a point about this trade, okay, when I closed it. I had to close a bunch of contracts, okay. The price that I end up giving you, and this was always true, and I've been asked because not to end up doing this anymore, and I just kind of want to put it out to you guys. I actually give you the worst lot that I got filled. So if I'm, say, closing, I'm going to just round the number. I'm not telling you I trade this. If I have, let's say, 100 butterflies to close, and I am buying back my iron butterflies, and I buy a chunk of them back at $52, and I buy one chunk back at $52.80. I give you the price of of the $52.80. I give you the higher price that I paid, so I give you the worst P&L. Okay, so when I end up doing that, when I had a conversation with another member, he said, "Oh, I'm getting great fills," and he told me the price, and I said, "Well, your fills aren't as great as you think, and here's why." So if I end up showing this to you, of where we were on our two graphs. Let me just bring, right, you can see that, Tom?
Yep, sure
okay.
can.
So, the 9.2%, I was speaking to a few students, and one got a 10.9, and another one got a 10.6, and they were surprised that my actual number was less than that, okay, from when the numbers were shared, because of what I end up doing. I just think that was fair. What I'll do from now on, because to give you an accurate picture of where you're getting your fills, I will end up giving you my average price. Okay, not my worst. That was the trade. Okay, this, I would tell you that the December trade had more adjustments than normal. The January trade gave me my profit a little bit earlier, so when they give it to me, I take it and I run. The time when I end up sticking around is when I have to stick around because they wouldn't give me my money, right? They won't give me my profit. So that's where we're gone. Okay, one of the questions is, can I show the first slide in January again? Yeah, I definitely can. Okay. Here was the first trade. Okay, if you remember here, we're looking at the 50-point difference between the puts, okay, on the upper wing. And over here, you can see that there's a 65-point price difference. When I did this, we were very close to at the money. My deltas, some people might say, oh, your deltas look to be very, very negative. Okay, which means that if I run up, I'm going to lose a lot of money, so people get worried about it. Okay, and yes, Tom, thank you very much. These numbers, they're not plus 10, it's 20. Tom?
Yeah, it's actually plus 20 minus 40 plus 20.
Exactly, yeah, and that's the person who ended up saying is, so when you take a look at the graph is correct. Okay, the quantities weren't. So it was plus 20 minus 40 plus 20. Thank you very, very much, okay, for putting them down, Tom, okay, in the chat. So my deltas are negative here, okay, and that's where, say, well, if you run up, you're going to lose a lot of money. Because of the broken wing butterfly, I don't have a specific delta number. I say, well, when you end up putting in trade, you end up always needing to go here. When you're going to do a broken wing, it's going to depend on how much extra wing you sell on the downside. Because remember, basically what this structure is, this is a 50-point wide butterfly with an extra 15-point short vertical foot that I sold at the bottom, right? You need to be able to kind of break up the positions in your head that way. And I did that because I was collecting enough money for this vertical. When I collected enough money for the vertical on the left-hand side, I don't have as much to worry about on the right-hand side if the market runs up. So I didn't mind if the deltas were a little bit more negative. You wanted to see the adjustment. Okay. I adjusted in two ways. Okay, if you take a look, here's the existing position. Okay, what I ended up doing was, and let me show you on the graph because I know this is a lot of trades. So instead of me breaking them all down for you off the bat, let me show you on the graph what I was doing. I was basically taking this vertical, okay, and I was moving it to the right. I was moving it up. It was 65 points, okay, beforehand. It's now going to end up being 70 points. I took this, okay, vertical, the upper vertical. Remember, it was a put vertical that we were long. It wasn't an iron condor or an iron butterfly. I took this vertical and I moved it up also, and I moved it from 50 points up to 70 points. Now, the problem when I end up doing that is now, while I'm positioned nicely in the fly, now remember, it's not broken wing anymore, so I don't want to end up having, I don't want to start out here on the edge. I want to end up being, a third, maybe a halfway between, down, or if you will, up the right-hand side of the slope. So I'm in a good position, but I need to end up buying extra calls. So I could do this one of two ways. I could either close the whole trade and then open the whole trade. I tend not like to do that. What I tend to like to end up doing is widening my trade out because it becomes flatter, and then I like to end up taking the upper wing and moving it up first, and then taking the lower wing and then moving it up when I'm adjusting upwards. Now let me show you how I did that. When I took the upper wing, what I did was that I bought back, okay, my put spread. Okay, remember this was a long put spread. So I bought 20 of these, and I sold 20 of these. I'm sorry. Here, right? You can see this. I bought 20 of the 40, and then I sold these. So now my puts are gone, and I need to end up having a new spread. Remember, that was 50 points. And then I did this in a condor, an iron condor, where I bought it. I sold the iron condor in the structure. By the way, when I sold the iron condor, I'm using a little bit more margin, but I'm also collecting more theta. And then I ended up rolling it up here where I only ended up having the 70 points. So I moved it actually from a 50-point wide wing to a 70-point wing. Then I did the same thing with the puts. I needed to roll my puts up. And so I rolled the puts up with a condor. So I sold my 20 here that I had, which were my longs. I ended up rolling up them from 1965 to 1980. Then I bought back the other, right? I bought back the other 20 that I was short. Okay, so now my 2030s are completely gone, and I sold, okay, the 2050s. So I rolled one by selling an iron condor. I rolled the other part, okay, by buying by buying a condor, a put condor. And so it was rolled up in two separate segments, and then I also had to end up buying my extra calls. And so in the graph, it kind of ends up looking pretty simple. Oh, you just shifted. It was done in two trades, plus the extra buying the extra call was done in a separate trade. Okay, that's the way I ended up doing the adjustment. And so, any particular reason for using all puts over an iron condor configuration? No, there was no reason whatsoever. I had originally tried to end up getting the iron condor filled. They weren't giving me a reasonable price. I went and I took a look at the pricing on both of them. They were relatively close, and so I just got frustrated that they wouldn't fill my iron condor, so I just switched it over to to all puts. I know that if I'm going to end up starting the trade with all puts, I know that in my if I roll upward, okay, which is usually the case because you're starting the trade, okay, usually with the long strike at the top end of the broken wing being close to the money. So if nothing else happens, or even if we pull back a little bit and if enough time passes, I'm going to have to end up adjusting. So I know I'm going to end up adjusting into my iron, so that's why I ended up doing it. In this particular account, there was plenty of cash, so I didn't need to end up doing it. I will tell you the reason why I use irons most of the time is because they're going to end up being traded in an account that will end up having a bunch of, either closed-end funds or bonds or something. So I can't use cash. I have plenty of margin to use. So it's actually pretty smart. I was speaking to those of you guys who know Stephen Shannon, and when he talked about the performance, because he trades a modified version of the Jeep that he and I used to trade years ago. Telling me his performance, and then he had another 5% on top of that because of the closed-end fixed income fund that he ends up having in the account that he uses as a margin vehicle. So he still gets to keep his 5% interest, and all of his trading profits are on top of that. All right, because it doesn't cost him anything to end up setting separate money aside. That's the biggest reason why I always use irons. Okay, that was pretty much it. Any other questions? Okay, so if I end up going back over here, you can end up seeing the two trades. I think for those of you that followed along, you guys may have done pretty similar because I had done so many trades here. But here where I just did two, okay, you guys didn't lose as much from my execution to yours. And because I gave you the worst pricing and because I wanted to end up getting out of the trade, what ended up happening to me, by the way, like I said, is that I got 90% of the trade off, and then they were kind of freaking holding me hostage, so I just I bowed just to get out of the trade. Like I said, the overall profit was 10% on the month. We were only in the trade for 32 days, so it was time to take the money and run. Okay, Tom, if you just want to end up helping with some of the questions. Okay, I have that Sid is saying this is a good position. It's inside a new tent. And I could end up moving to the right. Yes, I definitely could. Okay, there's no question that okay, my last position, and you can end up seeing when I ended up closing everything. It's a decent position. Okay, there's no reason that you'd have to get out of it. Here's why I did get out of it. Every single day, this portion of the line is going to get higher. And this the left-hand portion is going to end up going up, and the right-hand portion is going to go down. Because of the skew, it's not going to be pulled up in the center. It's going to be pulled up more, a third of the way down, half of the way down this line. So I know my deltas are going to get more and more negative. My gamma is increasing, and while there is a ton of money to be made in this trade, I kind of take a look at it, and if you want to end up trading this into expiration, and I've tried to do this, God bless. I want to have less stress in my life, not more. And if I can end up putting, a 10% trade down in a month, okay, where I never had any real risk, and my February trade is looking really, really attractive, why stay in it? It was time for me to end up closing this out because I'm going to roll all of my money into the next trade. Okay. Next question was, would I mind touching again, okay, on the criteria that I look for that allows me to decide if I'll end up starting off with a broken wing butterfly or if I start with a balanced butterfly? Yes, I'd be happy to. So here's the question. Okay, when I come back over here, let me go to December because you guys didn't catch this, right? Okay, here's my first trade. Okay, this is the December trade. I started off, maybe a quarter of the way down here. you can end up seeing that I only bought one call, okay, for the 10. You can end up seeing that my deltas were very, very flat. And now the reason, also if you take a look at my wing here, is 75 points, and my wing here is 100 points. So when I take a look, my put wing's 100 points, my call wing is 75 points. Remember I told you the 5 to 7 ratio? Well, 7.5, right, 7.5 to 10, that's what we're doing, or 75 to 100, isn't as much. So number one, I need to end up buying a call, okay, to flatten myself out. Think about the calls are always my afterthought. My first thought is always the position. Okay, so I would like to end up, okay, putting it all the way out at the edge if it was a 5 to 7 ratio, but because we're, or, you know, a 50 to 75 point ratio, but because we're less than that, we're 75 to 100, I have to end up bringing it in a little bit. But still didn't end up adjusting my delta, so I had to end up buying more. Now, if the question is, because this was the initial part of the question, is am I using the broken wing versus a non-broken wing? I prefer and I always start to look at a broken wing. Now, here's the challenge. Okay, and let me show this to you over here. Okay, here's the challenge. Here's Thinkorswim right now. Here's February. Okay, so what I am going to look at, I don't have enough strikes here to show this to you. Give me a second. Let's get 125 strikes. That'll do it. $125 strikes. Okay, so when I'm taking a look at it, I'm taking a look at what the implied volatility is in the difference. Now, if I end up having an even butterfly and it goes 100 points, say on each side, versus if I'm going to end up doing, say, a broken wing, let's see if I do 75-point wide butterfly versus a broken wing where I do 75 points and 100 points. Basically, remember I told you about doing project dissection? So basically or position dissection, basically this is a 75-point butterfly where I sold an extra 25 points here. So the question you're asking me is, why did I decide to sell the extra vertical down at the bottom, right? That's the difference, okay? So you need to be able to dissect the position to be able to dissect your question. Okay, so now what I'm going to end up doing is that I'm going to end up looking at the difference between the implied volatility of, say, that extra 25 points. And that extra 25 points, it doesn't really make a difference where it was because the market's moved and it's a different trade now. But let's just take a look at, let's say, the difference between the 1900. Right. Let's take a look at the difference between the 1900 and the 1875. So I'm looking at the difference between the implied volatilities. Okay, I look at two different things. The first thing my eyes always go to is I look at the implied volatilities. The second thing my eyes go to is how much extra am I going to end up getting. So one of the things that I'll end up doing is that I'll end up playing with the position, and I'll say, well, what happens if I end up, using this strike versus that strike? And I'll have multiple, trades on the bottom, and I will end up then looking at my Greeks both up and down the line to be able to see which my Greeks look better at. Okay, this, by the way, is the for those of you who've been following along, this is the February trade. Okay, markets pulled back significantly, even though I was negative delta because the vols have jumped up a little bit. Okay, my number is minus 0.5% so far since I put it on, right? Because it's $50,000. Okay, so you can end up seeing that there. Next question. Sorry, I meant what was the starting position for which I used the deep in the money, calls. Okay, I'm sorry. The answer to that question is I'm only going deep enough in the money, to end up balancing my Greeks. Now, a couple of things about the in the money, and the December one's probably a great one to end up showing it to you on, if you take a look at the position, you'll say, Jim, why in the world do you buy a 62 delta call? John Locke or other folks, they end up liking to end up using 80 points. Realize what they're doing is a little bit different. First of all, Okay, first of all, they're always starting with a symmetrical butterfly. Here, okay, I don't have a symmetrical butterfly. So I don't need to end up buying as many deltas. I need fewer deltas, number one. Number two, if the market pulls back, and we see this, by the way, right now, right? For those of you who saw the initial graph on it, it looked like if we pulled back, it was going to end up making money. This is the February trade, but we're not, right? I'm sorry, this is the one lot that I keep. It's the same thing, though, but we're not making money. You can see that we're actually losing money. Why are we actually losing money here? It's because the volatility went up. So what happens is that I know that I'm going to be losing money towards volatility if we go down. I know that. I know, right? Remember the analogy was my bent Kawasaki handlebars. I know that you guys think this line is here, but I know it's actually a little bit lower. So, and the reason why it's lower is that as volatility pops, because I'm negative volatility, I'm going to end up actually losing a little bit of money. So therefore, by end up having a strike that's closer to the money, okay, I'll end up getting a much higher ratio of making volatility dollars, okay, when I'm closer to the money than if I was much further below the money. So that's why I'm kind of balancing the two. And where I end up positioning it, it's really to end up, okay, looking, because when I put this trade on, I just don't look at my P&L. What I end up doing is I look, well, I'll show you what I do. It's probably easiest. You can end up doing this on anything. I've been doing it on Thinkorswim since about 2000 or 2001, so I've just gotten very accustomed to this. I'll take a look at my expiration days. My day steps. Okay, I'll end up taking this up to the maximum before it doesn't work anymore, and I believe it's going to be 16 or 17. Let's try 18. Right. I'll take a look at what these maximum number of days are before it ends up losing. Okay, it's 17. Then what I end up doing is that I know I'm not going to stay in the trade the last 2 weeks. Okay, I'd like to be out of it, okay, even before that. So instead of looking at all 4 days, I'm going to end up dropping to 3 because that last day is nothing but noise to me, or that yellow line. This is my real graph of what I'm looking at. I take a look at my P&L. Okay, if we're down 10%, the other thing I end up always doing is I want to see what one standard deviation is going to February. And I guess it's not showing. And I'll take a look at what my P&L ends up looking like. Then what I'll end up doing is I want to see how my Greeks are going to trend. So I will go through all 4 of my Greeks. I'll take a look at where's my delta and how will my delta change. You can see, remember I told you we're going to become more and more negative delta as time passes. Look, this kind of shows it to you. It shows you if nothing happens with the passing of each line, which is 17 days, and my deltas will become more and more negative. The dates are right over here, by the way, if you guys aren't familiar. So the magenta line or the pink line, whatever this is today's date, and then the aqua line is 17 days after that. The more of that orangey salmon color line is 17 days after that, and then the white line is 17 days after that. So every single line, I'm going to get more and more negative delta. If we pull back, I can see that I'm going to be negative delta for a little bit more. If we end up getting to the point where my deltas get positive, that's when I worry. A lot of people say, well, where's the long strike? What do you end up doing? I'm looking at my deltas, and I'm looking at how they're going to end up morphing. The next thing, like I said, I just go down. I take a look at my gammas. My gammas are going to get worse and worse and worse. By the way, if I show you this, okay, this is why I don't go to 4 steps. If I show you 4 steps here, look at how, I don't want to deal with this gamma. I want to be gone long before that. So that's why, to me, that's just noise. Let me look at this. Okay, at 4 gamma, I can still deal with it. Okay, if I'm very negative, depending on where I am, but I want to end up managing. Probably the most important thing to end up managing, and what retail traders do the least about, is making sure that they're managing their gamma, not just their gamma, but their change in delta. And I showed you how delta will change with time, not just with a point movement. Because remember, what's gamma? Gamma is how much delta will change with one point of move. Well, how much will gamma change? How much will delta change with 1 day of movement? It's not theta, right? Theta is your P&L. So it's kind of like the theta of your delta. Instead of getting hooked, all tied up and bind down, okay, with understanding all of the math, it's just easier for me to look at the graph. Okay, when I'm looking at my gamma is going to get more and more negative with with passing time. That's what I need to manage. Those are the two that I'll look at. I don't worry too much about volatility in this trade. You can end up managing it reasonably well. I don't look, again, too much of theta. I know that a lot of people look at your theta to delta ratio, and it's something reasonable to end up looking at. I know where my theta is going to end up, really growing. But, it's a trade-off. The more I end up getting in my delta, the more I get in my theta, the more I have to end up worrying about movement and my gamma risk. Tom, there are a few more questions here. Let's finish these things up, and then we should probably shut down. And I know I've gone to my time here. If you've been reading through the questions, I don't know if you can end up grouping them to me. A volatility smile, I'll just make the one comment. Yes, I've looked at it. What volatility smile will end up doing is probably give you a little bit closer or accurate T+0 graph. But it won't give you the correct P&L for your current position. Okay, so that's the trade-off. And because, it was kind of like my second motorcycle after my Kawasaki, I got on it and the handlebars were straight. I couldn't ride it in the beginning. I had to readjust my eyes. So yes, okay, the volatility smile would give me straight handlebars on my motorcycle. And for a lot of people when you're learning that's a lot easier than to learn on my Kawasaki that I put on its side. So that's my commentary. Tom, if you could end up summarizing if there are any other questions that we should end up answering right now, because I know we're short on time.
A quick one. Cheryl asked, do you all use individual implied volatility for your Greek analysis or shift models?
Yeah, no, and like I said, my eyes have just been adjusted, over 15 years that I could do that. By the way, for those of you who don't know, you can end up changing it in the settings. Okay, if I end up getting out of here and I show it over here, I'll show you guys how to do that real quick. For those of you guys who don't know it, all you do is you come up to Setup, Application Settings, Display, and it's here. You can choose volatility smile. If I go to volatility smile approximation and I apply it, and I end up coming back to my graph over here, and I end up showing it to you, I'm now on P&L. My graph is significantly different. The way to end up taking a look at this, by the way, if you want, you end up keeping one graph side by side. Okay, you keep this on the side, and then you click back and forth, and you can see how your line changes. So, I put this on a separate screen. I just drag this over to a different monitor, and then I change it, application settings, setup application settings, display, and volatility calculation. Okay, and I'll go back to my bent Kawasaki handlebars that I like. Okay, what else?
I think that's it. So thanks, Jim, for everything. I've updated the slides, so I'll print out a PDF version of that and attach it to the recording.
Okay, Tom, if people want to end up following along on the trades, we've done our 2 trades. We're going to end up, do we have here? All right, this is pricing for the Kevlar service will end up being the same as the other trades. You can see it there, $119 a month, $300 for the quarter, $550 and $1,000 for the year. The one thing that Tom and I wanted to do as a thank you, okay, and we can do this because this was our trade, is that if you buy any other service, if you're a gold member, if you've signed up for somebody else's service, you'll get the February trade to its completion. Okay, so I'll end up including that for you guys who are already members as kind of like a thank you. If you sign up, you'll end up getting the extra one.
And you're already following the Kevlar, don't buy it because you get the Feb trade for free.
Exactly. And then afterwards, but this is for anybody who isn't already a member or on any of our services, these are the prices, and these will be the prices for everybody the next month. Any questions about that?
Doesn't look like it.
Nope. Okay. And then, Tom, if you just want to end up talking, we started a mentoring program. We have several mentors who will end up taking you through the different trades if you want. And Tom, if you just walk through this offering we have for them.
Yeah, we have a nice offer from OptionView for mentoring students that they get the software for 6 months as part of being a mentoring student with us. So that covers 12 mentoring sessions. You can have up to a year to complete it, but we would think most people would take 3 to 6 months. If you want one of the expert services, you can get it at a discounted price. It's I think $400 for 6 months instead of the normal $550. So that's a good discount. Also throw in the covered call class that Jim taught earlier this year. That was pretty good. And you get the annual gold membership. And also we have a members discount page, so you can have access to all those. Like, for instance, if you like OptionView and you want to keep using it, you can get a 10% discount on your purchase of it later. So pretty good value for what you get. And most of the mentors are experts. So Brian Larson's teaching 1 or 2 students, and Amy's thinking about it. So it's a good value with good instructors that are all trading and making money with their trades.
Okay, Tom, quick question. Zune was asking for a summary. Zune, what were you looking for in a summary? What we're going to do is that we're going to fix the graph. We'll put this presentation in the class notes so you can end up referring to it. As I had mentioned before, for those of you who don't know where this is, if you just end up going to classes, Jim and Tom's Kevlar alerts, and then we'll have different things. So like when I've been sending out the messages, here are the different messages that get sent out of all the different trades. We'll end up including this in docs, okay, this presentation that we've just done. Here's the history of the trades that we've done so far with the pricing that we've sent out. So all of the information is really here. If you wanted a single summary page, right, if you wanted a single summary page, to me, this is the one that I look at. It's what are the trades. If you wanted to end up having a summary of the trade, it would end up being this presentation. We end up having that, and then I really haven't been sending out emails because most people just wanted the short alerts. Okay, so I've been sending them out as messages and not so much full-blown emails. And then we have history. Okay.
I think there's also around too about the Kevlar, so that would be in the main library.
Yeah. The other thing that we end up posting is usually about once a week, maybe a little bit more, okay, at times, maybe a little bit less at others if there's nothing going on, is that I'll end up putting on I'll put these images up. I'll end up using Thinkorswim. You can end up seeing, I'll always give you a little explanation about what was going on. And then there's a picture of the graph when we put on. By the way, here was the graph that I showed you. Remember, right now we're pretty close to the short strike. So this says we should have been making money, but we're not. My Kawasaki bent handlebars. I knew if we came down here and volatility popped, I wouldn't be above the T+0 line. I'd probably be close to it, or just maybe drop below it. And if I end up showing you where we are now on it, right, and I'll give you the expiration graph because that was the picture. Okay, let me reset that. You can see that we're a little bit below zero. Right, but again, here's something. Where do we sit in the graph? We sit perfectly. What are we going to end up doing at this point? The answer is nothing. So, okay, guys, a few minutes over. Hopefully that was really helpful to you. If you have any questions, shoot them to Tom or I, and thank you.
Yep, thanks, everyone. I will close this up and get it in the library ASAP. So thanks very much, Jim.
Thank you.